Hey everyone, welcome in to another daily editorial here on the KE Report. In this segment, we're going to be talking breakouts. There are breakouts in a lot of different sectors, either to 52-week highs or to all-time highs. So a lot for us to cover and trying to balance out why these breakouts are happening and just how sustainable a lot of these uptrends are. We're chatting with Mike Larson, editor-in-chief at MoneyShow. Mike, as I said, look, there are a lot of breakouts for us to talk about. Let's start off with the broad averages. The S&P right now moving to all-time highs, and that's after a bit of weakness as we turned the quarter over into April. It went down about 3 weeks in a row, the S&P, and now we're 4 weeks past that, and well, we're back at all-time highs. It just seems like the weakness in markets, the dips continue to be bought. Mike, is this just a continuing trend that you're seeing?
Look, I think, when you roll the tape back to April and we had some concerns about, okay, maybe the Fed's not going to be as easy as some were hoping, and maybe inflation's going to be a little bit more of an issue than some were hoping, and maybe, we're not going to get as many rate cuts and earnings. We've seen some of those companies that in stocks that really went, gangbusters heading into earnings, and then the earnings numbers were great, but they weren't the greatest. So therefore there were pullbacks. I mean, there's a lot of things after a sort of a turbocharged first quarter. There were a lot of things that were arguing for the market to take a breather, and that's what we saw in April. We had the best first quarter for the S&P since 2019. We had a record high for gold above $2,400 an ounce. We had Bitcoin hit an all-time high above 73,000. I mean, a lot of big milestones were hit in the first quarter. So, you had extreme optimism, a lot of bullish sentiment, and then things that came out on the economic front, on the earnings front, whatever, were good, but not great. And a few of the economic things were, okay, mildly concerning. So what happens when you have a turbocharged market that runs into really good, but not good enough news? April happens, right? But I mean, we didn't really do any significant technical damage. I said, even when markets were pulling back by a few percentage points, I said, look, yes, the inflation news wasn't as good as we kind of were all hoping, but the hurdle for the Fed to restart rate hikes, basically to start tightening money down the road, is so much higher for the Fed to jump over than the hurdle to say, you know what, we are going to cut. It just might be a little bit later. That I said that, you sort of look from a risk reward perspective. I mean, why would you get overly negative when the chance the Fed will ultimately have your back versus the chance that they will be fighting you? The odds are much more in the have your back stance. And you back out. And so that was kind of, where I stood in April, and I got up on stage in Miami and pretty much said the same thing at our Miami event in mid-April. And then I kind of said the same thing this past week in our event in the San Francisco Bay Area. Look, it's just a little bit of a correction. Don't get too worried about all the big things that have been driving this market are still there. The Fed has gone from rate hiking to rate pausing to laying the groundwork for rate cutting. The dollar went from soaring to stumbling to stabilizing. The stock market went from a defensive be boring stance to an offensive be bold one. And the credit markets, since the sort of bank stuff we saw at the beginning in Q1 of 23, have gone from tightening and worrying to stabilizing and relaxing. You add it all up, and it's a pretty bullish cocktail. And what do you know? Here we are, at all-time highs again, or right around there for the Nasdaq, for the S&P, the Dow, and so on. So I mean, I'm not surprised by the action, and I've been telling people, don't freak out about what happened in April. Things are still bullish, and here we are.
Yeah, Mike, it has been a pretty bullish cocktail. And I guess coming into this year, if you think about the end of last year, it was really placated around the Powell pivot party that, we were going to see 7 rate cuts this year. Obviously, that didn't pan out, and it's down to either one or no rate cuts by the end of the year. But that hasn't fazed the markets at all. And to your point, a lot of the economic data wasn't as dire as people were expecting. Everybody thought we'd have a big recession this year that never came. But there seems to be even an uplift lately, taking things to a new level, maybe going from bold to a little bit more euphoric. It's reminding me a little bit more of what we were seeing in 2021, maybe not to the same degree, but the meme stocks are back. And we've seen a push into the commodity sector, into the tech stocks, but also into a lot of other areas of the market that are spiking up. Do you think that maybe the markets are a little too euphoric here at this point, or do you think it's just solid growth because of a reflation trade?
Look, you're seeing some of the ridiculousness, the meme stock stuff this week we had, back to the whole, this guy posts a meme of leaning forward in his video gaming chair and all of a sudden AMC and GameStop, quadruple from their lows to their highs in a couple of days. So sure, there's some of that stuff going on. But honestly, I don't think it's anything like what we saw back in 2021. I mean, you had a money losing tech company, another loser do nothing but, copycat SPAC company coming public like every single day. I mean, we're talking about, tens of billions of dollars worth of just junk being dumped on the market to take advantage of gullible retail investors. You had a lot of just all kinds of corporate announcements and corporate behavior that was just happening, not because it was smart, but because money was free. I don't think you have that anymore. And, it's not just, I mean, interest rates are different. You can earn 5%, give or take, risk free. There are other things that you had going on back then that are different from now. You're always going to have kind of pockets of ridiculousness. And what happened? AMC came out, and as soon as people drove up its stock, it said, you know what, I'm going to, swap some bonds and issue a bunch of new stock to these fools who are bidding up the price. And what happens? The price tanked. So, I mean, it's a different kind of market. So while there are maybe one or two pockets of that kind of thing going on, I don't think it's the same kind of broad market concern, which is a very different story than I told back in 2021 when we were talking too, and I said a lot of this stuff is going to be dangerous, and many of those SPACs just completely disappeared. A lot of the profitless tech companies were down 50, 60, 7%, 70% from highs to lows. I would also say that we're talking about some of these things we're seeing in various parts of the commodities market. We're seeing in other sectors outside of tech. Utilities, for crying out loud, have been very positive recently, which is kind of another tell about the interest rate outlook. There's a lot of things going on that speak to a broadening of the market and a different kind of market where it was sort of like all just speculative garbage that was doing great back in 2021.
Yeah, that's a very good point, Mike. What about commodities? Because commodities are also doing well, playing a little bit of catch up. They were kind of lagging these markets. You can argue that commodities, hard assets, have been lagging the markets for decades now, but at least they're starting to break out. Copper just recently touched an intraday all-time high. We have gold at all-time highs, or at least it recently broke out to all-time highs. What's your take on the commodities and them breaking out as well?
Yeah, I mean, I've been very bullish on gold for a long time. I mean, since 2018, and for a long time after the initial run, it just kind of chopped and flopped around. But we've obviously seen a big breakout there. I think that the outlook is very solid for gold. When it comes to things like copper, I mean, base metals kind of historically, I mean, heck, you don't need me to tell you this, historically kind of traded in tandem with each other, but copper's got this extra kick juice to it coming from the fact that we're building out, transmission lines for power and things that are going to use copper. EVs are big metal users of copper and so on. And you've got governments and investors kind of scrambling to secure supplies of this stuff, rather than get boxed out by China. So you have some of these things going on that make that particular part of the industrial metals market be extremely positive. I'd like to see a little more participation from energy and from energy, that corner of the market. But other than that, a little bit of a fly in the ointment. I think things look pretty good. I mean, it's broad enough, again, not just in the commodity space, but the advance overall is broad enough that this isn't just the sort of tech-centric one-trick pony kind of market. It's something that's more encouraging from a longer-term perspective.
Well, Mike, you brought up the energy sector, and I would submit that some of the copper's run is exactly what you said. Thinking about the power transmission needed for EVs, for data centers. Where's all this electricity going to come from? Look at nat gas popping up lately. It's not breaking any records, but it has actually got off the floor and started moving higher because a lot of people are anticipating maybe more nat gas power plants. You've seen uranium have a pretty big run over the last couple of years, and it just started taking off again recently. Aren't those playing into the energy theme to some degree with the commodities?
Yeah, absolutely. I'm glad you actually brought up natural gas because there's been a few people that I follow, and even one or two mainstream kind of pieces that said, look, I mean, how's all this stuff going to get powered? It sounds like great. Like we've got this wonderful whiz bang technology, whether it's AI, whether it's data centers and so on, and EVs. But yeah, you still got to, burn something at the front end or turn something into energy at the front end. And then, in the middle part of it, get it to where it needs to go to power those kinds of things. So yeah, I mean, nat gas is kind of one of those backdoor or less popular plays on the tech boom and the EV boom, and the power that's going to need to fuel it. So I think a lot of those stories probably have legs. I mean, so yes, I mean, you brought up some great examples that it's not just one thing. I mean, it's not just gold, it's not just copper, it's not just commodities for that matter. It's a lot of different parts of the market, and that are benefiting from a generally bullish economic backdrop and a getting more bullish interest rate environment. So, I don't want to sound Pollyannish or Goldilocks or anything, but and I point out I'm certainly not a perma bull by any way, shape, or form. There's been plenty of times we've talked over the years where I've been a lot more cautious. But when it's a time to be bullish, get bullish. The worst thing you can do is when it's a time to get bullish and you just sit there singing a bearish tune that doesn't make anybody any money.
Yeah, very good point. Seems to be a lot of opportunities out there. What about investor interest or what you're seeing in the commodity equities? Copper stocks have been doing well. Even most stocks have been doing well, but have you noticed any standouts in terms of individual commodity sectors, equities for that matter, just outperforming?
I would the only thing I'd say there is just that you're seeing broader participation. Again, there's sectors that I mean, when I look at what I think has opportunity and what some of our best speakers, people, Jose Torres at Interactive Brokers, Ed Yardeni at Yardeni Research, they were a couple of the speakers we just had in the Bay Area at our event there. And, they talked up industrials. They talked a little bit more about financials. Some of the SMIDs, all the small mid caps that have been left behind. I mean, if the economic outlook is getting better and we're not going to have this recession that never showed up, then there's some opportunity there. I tend to agree. I mean, I think things that have exposure to a better growth outlook, whether it's cyclicals, industrials, transports, and yes, to some degree, energy equities. All of those things look pretty good to me too. So I think those guys were on the right track. It kind of aligns with my own thinking, and again, I think that the catch-up theme has a lot of merit to it, just because again we've transitioned from this sort of all tech all the time market to a market that the sectors that have been left behind are likely to start, if not leading, at least keeping pace with some of the parts of the market that previously were leading themselves.
Well, Mike, just to that point, a lot of people point to the small cap section of the general equities as one that's lagged a little bit. Some of that is because of the higher interest rate environment, the higher for longer scenario. But with the catch-up trade, could there be opportunities in some of those small cap sectors to actually get a little bit more beta and action to the upside?
Yeah, absolutely. It's kind of funny, just as we're talking, I'm pulling up some of my charts. I mean, year to date, the XLK, which is the tech ETF, I mean, it had been radically outperforming small caps, but right now on a year to date basis, it's only up about 2.5%. On a year to date basis, the IWM, the Russell 2000 ETF, is now basically flat. So, whereas earlier in the year, rolling into the late end of last year, it was like a 15 some odd percentage point advantage to tech over small caps. Now that performance gap is narrowing quite a bit. And I think that's the kind of thing you can see where it goes from just narrowing, but still in favor of tech, to maybe flipping the other way. So, yeah, I think that some of those things have been lagging. Some of those parts of the market that have been, just again, not able to keep pace with when everybody all they wanted to have was tech. That's starting to change, and I think that's going to continue to change. So, those are definitely opportunities if you're interested in the catch-up business.
Mike, what's a bear case here? What's something that could come out of left field, or even something that could be on people's radars that could turn this just generally bullish environment for a wide range of areas more bearish?
You're channeling my own brain, because slide 22 in my presentation there in California was, so what could go wrong? And I had 5 things that would sort of be at the forefront or the top of the uh-oh list. And number one was that the Fed gets uber hawkish. The data makes the Fed not just plan to maybe sit on rates or cut once or twice, but resume that hiking cycle. Obviously it's not in the CPI data, but that if the Fed goes back into uber hawk mode, we're in trouble. Second thing was commercial real estate losses deepening or accelerating. I've said for a while that this is not a systemic unwind. There's going to be losses. There's going to be, landlords that lose their money. There's going to be, other issues and so on. But I don't think it's going to be anything like what we saw in the housing market. But if I'm wrong, that's going to be a problem. The rest of them are, currency crisis thing. Everybody's kind of talking in the back of what's going to happen with the yen and so on. All right, that's maybe one thing out there. Geopolitical tensions. I mean, we can never totally bury that. The market the markets, again, I always say it's from a market standpoint, not from what's wrong in the real world. From a market standpoint, what's happening in Eastern Europe, they can deal with it. What's happening in the Middle East, they can deal with it. If China starts shooting missiles at Taiwan, the markets are not going to deal with it. That's going to be a problem. And then just, I said if the awful April turns out to not just be a pause that refreshes, then that's going to be an issue. But, clearly, as the early part of our conversation pointed out, April showers are leading to some May flowers here in the stock market. And, if that continues, then that probably I can scratch that off my list. But those were my top 5 what could go wrong kind of thoughts.
Mike, that summarizes it perfectly. Thank you, as always, for sharing your thoughts on these markets. And quite frankly, you have played these markets well on the downside and then back turning bullish. Well, still a lot of people were bearish. There's still a number of people looking for a recession this year and diving into this data and saying that it's just not looking that good. But look, there's also the bullish camp. And right now, the bullish camp seems to be winning because look at all the breakouts we're seeing in a wide range of sectors. And now even some of the lagging sectors playing catch up. We'll chat with you again in another few weeks, Mike. It's always interesting hearing what you're writing about, also what you're hearing at recent money shows. As you said, recent show in San Francisco. I will post a link to the Money Show website so everyone can stay up to date on where upcoming conferences are. Mike, thank you as always for your time.